Hello traders, Gary Wagner here just before 12 noon in Honolulu. It is Friday. Happy Aloha Friday as we say on the islands. October 18th, 2019, and this is the daily report for gold and silver, our weekend review, and we did see a week in gold. In essence, closing unchanged on the week, we had very, very little movement, and that's despite of an aggressively lower U.S. dollar. And that tells me that there is a concerted level of optimism about the Phase 1 agreement and a signature coming forth in November next month. Let's take a look at current pricing and then our technical studies. As I said, even with dollar weakness this week, gold really went nowhere in terms of a direct price change. When we look at a weekly chart, you'll see that it's nominal at best, and it closed at about the same place that it opened on Monday. Gold is currently trading at $1,493.40 and is down almost $5, $4.90. It's the dollar that I find so interesting right now. We'll go ahead and pull that up. That has really moved down dynamically. You can see that on this daily Henkinashi chart here. This is also a daily, but during the show, time permitting, we will look at a weekly chart. 96.91 down 0.44% on the day. And despite that, gold has really not been able to take off. And I think one of the reasons, the primary reason, is the guarded optimism about the agreement that was reached last week in Washington between the Chinese and the United States, and the fact that there is a decent probability that there will be a signature meeting in November in Chile between both President Trump and the president of China. Silver closed lower on the day, but really dramatically lower is not the case. It was down about 4 cents at $17.57. Platinum was the only thing bucking the trend a little bit higher, $3.50 at $896.50. And lastly, palladium did sell off a little bit, but only to the tune of $3.80, and is still trading dynamically above 1700. Yes, 1726.90. Let's take a look at our technical studies. We are looking at a weekly chart of gold futures. And as I spoke about in our opening statement, we can see that this week, gold prices closed in essence unchanged. You can see that by virtue of this doji candle. This is a weekly representation of what we have seen. It does indicate either a slowing of the selling pressure that we have seen over the last 4 or 5 weeks, or the potential for a key reversal. Dojis act in both ways. As you can see, we had this doji, about 4 weeks ago right here, and that was just kind of a pause before more selling came into the market. So we'll have to wait. You also notice a blue line here, and this blue line here represents to me an inflection point that gold must overcome before we can move to the next stage of bullishness, so to speak, that wave 5 that we have really been waiting for. And you can really see that, but you have to convert the weekly into a monthly, which I've just done. And that will allow us to view the point that I'm calling an inflection point, a really critical area, this blue line right here, because when we look at a monthly chart, we can see that for the last 3 months, specifically 2 months ago and 1 month ago, we had the market either open and then close at this point, or open below it, which was last month, and then close at this point. We had highs that came above it, but on both occasions, the market was unable to, on a monthly closing basis, trade above it. This month, we have not even challenged that area yet, and we're pretty much far through the month. And the reason it is such an important price point is when we take a look at how gold traded back through 2013, 2014, we can see that when it finally broke below, I think it was about 1537, and traded to the lows that came in at the end of 2015, the beginning of 2016, that's a really key point, because once the market traded to an all-time record high, it then began to trade in a pretty wide path between 1800 on the high and about 1500 on the low. That's the area that I've just put in green. And that's why it is so important on a technical basis that gold is able to take this particular price point out before we can honestly say we're moving to the next stage of a rally that's obviously been in place since about 2016. We are looking at a master chart of daily gold futures. We have a basic Elliott wave count. We have some Fibonacci extensions along with a fib retracement. When we look at recent activity, we have spoken about this dramatically throughout this week as well as last. We can definitely notice that we have had a series of lower highs. At the same time, we've had a series of higher lows, and that spells compression triangle. The theory behind this kind of a pattern as the price approaches the apex of the triangle, energy builds. When it hits that apex, there's a release. In other words, a price spike, dramatic price spike, either to the upside or downside, and typically the market will return to the prevalent trend direction, which has absolutely been higher. So I'm looking for the market to trade sideways for a little bit while longer and hopefully break above our resistance line and then move to higher ground. We have on previous weeks plotted where I think that price will take us, but what is important to note is that we are still drifting in a corrective phase in this phase 4 and are still awaiting the beginning of a fifth wave. This has been Gary Wagner, wishing you as always good trading. We will talk to you next week from Malaysia, by the way. I will be in Kuala Lumpur on Sunday and Monday of next week and then give a lecture on the following Saturday. We'll talk to you then. Have a great week. Bye-bye.